So now let's talk about the balance sheet. The balance sheet is the hardest thing for business owners to understand. And it's really the reason why I created this class. It's basically an equation. Assets minus liabilities equal your equity. So let's talk a little bit about that. So your assets are the things that you own. Your cars, your bank account, your receivables, your furniture and fixtures, your land, your intangibles. Those are all things that you own that have a value, okay, that eventually you could sell off and get your money. Liabilities are the opposite of that. That's things that you owe, money that you owe back to your vendors, your credit cards, your banks. Maybe if you're the officer of the company, you owe that money back to yourself because you loaned a bunch of money into the company. That never happens, right? So it's your IOUs, it's your debt. So the difference between those two is your equity position in the company. So you want, obviously, positive equity, which means your assets have to be bigger than your liabilities to achieve that, okay? So now we're going to break down the balance sheet a little further. There are things that are considered current, and there are things that are considered long-term. So your current assets and liabilities are the things, in the case of an asset, are the things that you can turn into cash within a year. So your accounts receivable, hopefully your customers are going to pay you quickly, and so that will turn into cash. Or your inventory, right? You're going to sell that off, hopefully, in the next few months and turn that into cash. So those are things that are considered current. On the liability side, it would be your accounts payable. Most of your vendors aren't going to extend you credit for a year, right? You're going to owe them in 30 days or 60 days or 90 days. Your credit cards are things that you owe on all the time. Then there's long-term. So on the asset side, long-term assets are your fixed assets, your furniture and fixtures, your land, your intangibles. Like if you buy another company and part of that purchase price is considered goodwill or the customer list that you bought, that's a long-term asset that will stay on the books probably till you sell. Long-term liabilities are your bank notes, your vehicle loans, things that you're going to have to pay over the course of several years. Then the equity section, so we've got our assets minus our liabilities, and the difference is equity. So depending on how you're organized, your equity section will look different. So some of you are sole proprietor, one owner. Okay, so you'll have an owner capital and a draw. Some of you are partnerships, so that'll look a little different. And then a corporation is like an entity on its own. So you don't see partner capital and draw accounts. So this is what it looks like if you're in QuickBooks for each one of those, or an accounting software and print out a financial. So the corporation doesn't have any partner or individual equity accounts. It's just got stock and dividends and retained earnings. So the nomenclature is a little different in the chart of accounts depending on how you're organized. Okay, so it would be easy if the balance sheet looked like this. Assets minus liabilities equals owner's equity. But that's not, whoever invented accounting, they decided to make it even more confusing. So this is not how they present it on paper. So what I want you to do, how many of you are good in algebra? Oh, come on, somebody's got it. All right, so what happens if what if I want to solve for assets? If this were a math problem, what would I do? You'd add liabilities to both sides. And guess what? That's what the balance sheet looks like. When you see it on paper, that's the way it's presented. And that's why it's so confusing to people, because you look at it that way, and I'm like, I don't really understand that equation. So it is still the original equation that is understandable. It's just presented in a different way.